Hey there, dividend stock investors. The stock market right now is tanking, and so I want to share in the video today the 6 dividend stocks that I'm purchasing right now. I always love a good sale, and I have earmarked 6 stocks in particular that are really compelling as values, as strategic positions for me right now in my personal stock portfolio. I actually share my complete dividend stock portfolio percentage allocation to each position over on Patreon. I will link to that in the pinned comment below. I'm going through a complete dividend stock portfolio update right now. And as I've been working on it, I want to surface right here on YouTube some of the insights from the work I've been doing. In fact, the 6 stocks I'm going to present today, I'm going to share the percentage allocation I have to each of them in my portfolio right now. These are rather large positions. One thing that I want to remember top of mind right now is I'm personally working a lot of hours. Perhaps I'm working as many as 100 hours per week right now because I am very busy at my job. My job has kind of peaks and valleys in terms of workload, and right now the workload is very high. And so what's interesting is these dividend stocks that we're all looking at right now. The stock market is correcting, and sometimes with the economy doing so poorly at a macro level, we all tend to think, hey, doom and gloom, nothing is good. But it's so important to remember that despite what the stock market is doing, despite the value that's being assigned to a company at any given time, there are many employees at each of these companies, like myself, that are working 100 hours right now, and usually per week, and usually during a recession. That's when a lot of good innovations come to fruition for the next economic cycle. And so I'm betting on the future. I am investing. I realize that the stock market may trend down even more, but I'm going to keep averaging into these positions. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPCEN. This is dividend stock investing for everyone. All right, everyone. So it's Friday night. I am not going to go to sleep tonight until this video is live on YouTube. I've already worked a really exhausting week, but I gotta keep going here on YouTube for all of you. If you appreciate the effort that I put into each and every video, please go ahead and smash that like button. It really, really helps me out. It means the world. Stock number 1, as you can see on the screen right now, some of you are going to be really surprised to see this, but it is Starbucks. It's my number 1 position right now. And Starbucks, as you can see right next to the ticker at the top, represents 9.0% of my portfolio right now. I have 9% of my money, of my dividend stock portfolio, that is allocated to Starbucks. And so it has trended down a little bit. It's down 28% from its 52-week high right now. I like that. That's why I highlight that cell in yellow. It's still richly valued. Forward PE is a 29 this year, 25 next year, but it's richly valued because they just brought out their reinvention plan. And in the reinvention plan, they forecast what's going to happen with revenue and earnings, and they are growing very rapidly. So this is priced as a growth stock, as it should be. The starting dividend yield now is 2.52%, which is pretty good because they just increased the dividend by 8.2% just this week. I'm so excited about that. And so I highlight that. That's a reasonably good starting yield, given that the 5-year growth rate on average is 12% per year. And so the market cap of this company is only $96 billion. I think this company could double over the course of the next 5 or so years. And what I really like about it is the rapid growth, the dividend increase, and Starbucks Odyssey, which is the next era, I would say, of their app. Is going to the blockchain. They're going to be offering some really advanced and cool user features on there to make the app and the company even more sticky to consumers like myself. What I don't like as much here about Starbucks is the valuation is rich. I cannot lie. It is expensive. I recently bought a lot more Starbucks, but I bought at inflated prices, if you will. Perhaps it will come down more. Perhaps it will not. I will just keep buying if it goes down more. And this is one where I have already been buying pretty aggressively recently. And my patrons know that because I share all those trades over on Patreon. But also I've been sharing a lot of those trades here on YouTube as well. And so that is Starbucks. Put in the comments below, by the way, what you think about Starbucks Odyssey, their dividend increase, their reinvention plan, what's going on with the growth over there. I guess one other downside of Starbucks, or one of the things I don't like perhaps, is some of the challenges they're facing with unionization, but it seems like they're getting past some of that right now. And so I want to share the second stock, core stock, that I'm buying right now. Check it out on the screen right now. This is Johnson & Johnson. And so believe it or not, Johnson & Johnson now is just slightly smaller than Starbucks in my portfolio. It is 8.9% of my portfolio. I have 55 positions in my portfolio, but you can see here very clearly that I front load it on the most core positions. The core positions are what really matter to me. And in fact, I may pare back some positions, but I'll talk about that at the end of the video. So the share price right now is 163. It's down 12% from the 52-week high. What I would say is this stock lacks the volatility of Starbucks, for example. It's a lot less volatile. It also has less dividend growth, but I love it because it's this kind of stock that's an anchor to the portfolio. I also love that based on the earnings estimates, the PE ratio this year is a 16-15 next year. It is trading at discount levels, I believe, because of the litigation risk. Starting yield is 2.77%, but with that low payout ratio of 45%, boy, there's a lot of room to increase that dividend and pay out shareholders even more cash flow. The 5-year dividend compound annual growth rate is only 6.11% per year on average. That's why I don't highlight it. It's below my target goal of at least 7%. Market cap is huge, over $400 billion. This is a company that is almost a mutual fund within the healthcare space. I like that everyone needs healthcare, even though we're headed into rough economic times, I would say. Everyone needs healthcare. The valuation is great. I love the scale of this company. What I don't like, honestly, is I don't want them to spin off the consumer business. I know why they're doing it, to probably shelter risk of some sorts as it pertains to litigation. I also don't like the litigation risk. I continue to add to Johnson & Johnson. I add to it pretty regularly. I think it's a good value here, and it's a stable position, if you will. I think one of the things J&J highlights overall is what's happening just with dividend investors. I cannot imagine going through this type of market cycle without being a dividend investor. I'll tell you, just because it's only down 12% from its 52-week high. If you look at other stocks, tech stocks, especially tech stocks that don't earn any money, they are quite a bit more volatile and they don't pay out a dividend. And so it just goes to show that J&J, it's a bellwether for the dividend industry, and it shows what dividend stocks can bring to an investor during rough economic times. I want to keep going. The next stock, as you can see on the screen right now, these are all of the stocks I am buying right now. I am laser focused on them, is obviously PEPSICO. Now, PEPSICO is 6.2% of my portfolio. That's a lot smaller than J&J's 8.9 and Starbucks at 9%. I have some work to do here on PEPSICO. I want to get it up to at least 8% of the portfolio, and so I'm going to keep adding. Just like J&J, it's only 13% off its 52-week high. This just goes to show, again, these dividend stocks for investors who don't like volatility, for investors who want to sleep well at night, for investors who want something just a little easier to kind of stomach during rough times. Dividend stocks, core dividend stocks like PepsiCo and J&J, they tend to perform quite well, as you can see on the statistics here. Now, based on their estimates, the forward PEs are still a little rich at 24 this year, 22 next year. Perhaps it'll trend down more, but also perhaps it will not, because investors flee to quality during rough economic times. The dividend yield is a nice, juicy 2.82%, which I love. Payout ratio 69%. 5-year growth rate on that dividend is 7.39%, which is just above my preferred amount of 7% or higher. So I like seeing that. that. What I like about the company is the snack foods are very popular, very popular. It makes sense. Starbucks is very popular now as well. They just had their record week recently. And I think a lot of people right now, they are juggling multiple jobs. They have a lot going on in their lives. They don't have a lot of free time. They're kind of like me. Probably like a lot of you who are following along at home right now. And so snack foods, coffee, quick bites are really popular right now. Also, this stock has low historic volatility. It has economies of scale, and that's what I like. What I don't like, obviously, is it's still not cheap, and that's why during rough economic times, during a market correction, I just like to average in because perhaps it will go even lower from here. During the correction, during the pandemic era, I was buying stocks almost every day because I just didn't know what will the next day hold. Right now, we're not in that kind of situation where the market is in complete free fall yet, but if we get to that, I'll start buying every day. For now, I'm just adding to these positions, not all 6, but pick 1 or 2 or 3 of them on any given week. I'll be adding to them, and I'm super focused on core stocks. One thing that a market correction always tells me is how important core stocks are to me, because that's all I want to buy during a correction. But what's so funny is when the market is at lofty levels, that's when you see me going towards other stocks, adding new positions to the portfolio, getting a little distracted, and I have been personally through that cycle so many times now that I think I finally got it. That boy, next time the market goes to really lofty levels, which might take a while because we're headed for some rough times ahead, I'm just going to hoard cash. I'm not going to be trying to diversify into other companies. And of course, right now I am focused on core stocks. But it's interesting. I've been in this game for more than 20 years, but I'm always learning and relearning about my own habits as an investor, and that's okay. It is a journey. I want to keep going with the 4th stock that I am buying actively right now is McDonald's. As you can see on the screen in front of you right now, McDonald's comprises about 5.3% of my portfolio, so it's a little bit smaller than PEPSICO. So PEPSICO was up at 6.2%. So we keep notching down here, but still, even at 5.3%, this is a very respectable percentage of my portfolio of 55 stocks. And patrons, thank you. Corner patrons is where I share the portfolio and videos about the portfolio. On regular backyard Patreon, that's where I share all my stock trades. So corner Patreon's the higher tier with the stock portfolio updates. And thank you for hanging in there, corner patrons. I will have the new portfolio up there soon. This is kind of a precursor to what you're going to see. But McDonald's is only 15% off the 52-week high. Again, you can see these dividend stocks, a lot of them are less volatile than the overall market. I love that McDonald's has a forward PE, not this year, but next year of 21. I highlight that because it's finally getting into somewhat of a value territory for this name. I love the dividend yield of 2.39%. And the payout ratio is only 56%. There's room to increase it. I especially love that they're increasing the dividend. All of the stocks that I'm speaking of today are dividend growth stocks. No one, I would say, gets excited about 2.5% from a starting yield perspective, although I guess I do with Starbucks because I got so much money in it right now. But boy, we all get excited when there is growth rates on top of that because dividend investors know what can happen with dividend reinvestment over long periods of time. Yield on cost can get very high, especially with something like McDonald's where they're growing the dividend almost 8% per year on average. I love that this company has a massive real estate portfolio that they carry on their balance sheet at cost. I love that everyone needs to eat, and during a rough economic period, consumers are going to eat at places like McDonald's and Starbucks where they just, it's a quick bite and it's not going to break the bank. It's not a fancy restaurant, if you will. McDonald's, like Starbucks, has adopted technology really well. What I don't like, I guess, is perhaps McDonald's is not the healthiest option or it's not perceived as being healthy. And so some consumers may look at it as unhealthy. I think McDonald's, hopefully they're staying on top of that trend, but I would say they have more work to do. And I would say the valuation, perhaps it's still rich. And I think this is something I would say about the overall stock market right now, is it's come down a lot. But when you look at these dividend names, a lot of them, other than a select few like Johnson & Johnson and a few of the ones I'm going to share with you next, they're not at bargain basement values just yet. Maybe they will get there if we have a free fall in the market. But so far, I think what's happening in the market is it's recalibrating a bit. We're recalibrating from speculative positions towards investors putting money in quality names. And when money comes into quality names, even though they're trending down, they just don't trend down as much as the overall market. Hence, the valuations are still reasonably, I wouldn't say rich, but fair. They're fair valuations. It's not deep discount, but I just kind of look at the trends. The valuations are better than where they were, and so that makes this dividend investor really happy. I want to keep going. I want to share the next position that I am buying right now. As you can see on the screen in front of you, the next one is the Home Depot. And so the Home Depot comprises 4% of my portfolio. This is something I have added to in an enormous manner over the last year. And so it's now a big position, one of the largest positions in my portfolio. It is down a whopping 34% from the 52-week high. That catches my attention. This is a more volatile name than some of the others I've been discussing today. But boy, that volatility is playing in my favor right now. At $275, it's a no-brainer for me. I love that the forward PE is a 15 next year, 16 this year. This is a name I would say that is in value territory. It's not like McDonald's, which is a fair valuation. It's not like at PEPSICO, where it's a fair valuation. It's not like at Starbucks, where it's a fair valuation. I would say this is a bargain of sorts for a quality company like Home Depot. I think it's in a similar range to J&J, although J&J is at that range for a reason because of litigation risk. Home Depot is at this range for, honestly, I don't know why. The dividend yield is 2.75%, which is one of the highest of this bunch, which I love. Payout ratio 46%, which tells me they're going to keep increasing this dividend, and this is the quickest dividend grower of the bunch. So not only is the dividend yield up at 2.75%, but they're growing it on average by 16% per year. And so this is a long-term dividend investor's dream situation. I like that the products they sell are always in need. Home repairs are necessary even if the economy is bad. Quite frankly, projects might be more pronounced during a bad economy because consumers just can't move. With these interest rates being so high, it's difficult to buy a new home. I like the dividend growth. What I don't like about the Home Depot, honestly, I couldn't think of anything to say. I couldn't. And so Home Depot, that's why it's the number 5 stock on this list that I'm actively buying right now. I can't think of anything I don't like about it. What about the Home Depot? Put in the comments below if you can think of something negative about it right now. I just can't. It is good to be a dividend investor. I will tell you what else is good about being a dividend investor. I'm working now so much. It's been a long week. But while I've been working, I just kind of forgotten about the stock market. And it's okay. I haven't been tracking. Stock market's down. I could care less. All I care about is my cash flow. And the fundamentals tell me that that cash flow is going to keep coming in increasing amounts from these core dividend stocks, the ones I'm sharing today, that just do so well. And so I love working hard because I can just forget about the dividend game a little bit and let the stocks do their magic for me, produce cash flow for me while I sleep or while I work on other endeavors. That's the beauty of being a dividend investor. I just don't have to worry about this volatile market so much other than regularly deploying new money into values, or at least better values than there have been in recent months. Let's keep going. The last stock today, as you can see on the screen, this is one I covered recently in a standalone video. This is RAYTHEON Technologies. I will link in the pinned comment to the video I recently did. This one is another one like the Home Depot that I have added to in a massive manner over the last year. It's now 3.7% of my portfolio, and I've mostly been buying at higher levels than it's at now because the price is down at 81.86. 52-week high is 106. It's down 23% from the 52-week high, and so I'm loving it. I'm going to buy more RAYTHEON Technologies here. I like that the forward PE is at 17 this year, 14.67 next year, but the reason the PE is low is a little misleading in that when you look at the statement of cash flows, as I covered in my recent video, which I linked to in the pinned comment, unfortunately, from a free cash flow perspective, from a cash flow analysis perspective, the company has some work to do. It's not looking as great right now. Dividend yield is 2.69%. Payout ratio is low enough where I think they will keep increasing it as aggressively as they have. On a 2-year basis, they've been increasing the dividend on average by 7.6% per year, which is above my target of 7%. I love it. What I like about the company is defense is more important than ever. Unfortunately, it is a necessary thing as part of modern society. I think we all see that in the news every day. I think the valuation is pretty great. Although I am cautious about the cash flows, as I said on the statement of cash flows, that's what's not looking quite as good right now. And so what I'm doing again is I'm just going aggressively into these stocks right now. I have no concerns about them. I'm buying future cash flow. I could care less what my aggregate portfolio value is. Although, as I have been working on this update for Corner Patreon, stay tuned because I share how percentage-wise how much my portfolio value has fallen. And it did fall a little bit versus my last update in May, despite adding net new capital to the portfolio. That's what happens in a market correction. But I look at it like a spring. The spring just keeps compressing, and I'll keep adding more and more and more. But when the market turns up again, that spring will open up again in a major way, and the portfolio will be worth a lot more than it is now. But honestly, does it really matter? I never plan to sell. I'm just in it for the cash flow. All that matters to me is the ability of these companies to pay out their dividends in an increasing manner. And that's what I see so far. And I'm seeing a lot of dividend increases roll through as well, which is so wonderful. There was a dividend increase today from Honeywell, another position that I own that I've added to in a major way over the last year. And recently, obviously, the Starbucks dividend increase. Hopefully, McDonald's is coming next week. All right, everyone, if you enjoyed the video, please smash the like button. It means the world to me, really helps me out. Don't forget as well, if you have not already, go ahead and subscribe. That really helps me out too. I hope to see you all in the comments. Before I go, in terms of a full disclosure, I want to share that I own the positions today. In terms of full disclosure, I am long Starbucks, ticker SBUX. I am long Johnson & Johnson, ticker JNJ. I'm long PEPSICO, PEP, McDonald's, MCD, Home Depot, HD, Raytheon Technologies, RTX. I am also long Honeywell, ticker HON. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed investment advisor first. It's possible to lose money in the market, especially during crazy times where interest rates are going really high and equity prices are falling across pretty much all the asset classes. Now, speaking of interest rates, I'm also eyeing Treasury bonds right now as well. The interest rates are looking really interesting to this long-term investor who buys treasuries and holds them through maturity as a stopgap measure during retirement to supplement dividend income. All right, everyone, in terms of full disclosure, I am long treasuries. I love you all. I appreciate you watching the video, and I'll see you in the next dividend investing video.